If you had $200,000 in either available equity or savings, plus maybe a spare $2,000 a month, should you use that extra money to maybe pay off your mortgage more quickly, invest in shares, or invest in property? Now, many people assume the answer to that question is very simple. They'll chase the highest return. Yet over my now 23-year investing career, and over the last 9 years where I've helped over 500 investors invest in property successfully, I found that the answer isn't so simple. In fact, chasing the highest return can often lead to wrong conclusions. Now, I'm no financial advisor, so this isn't financial advice. It's just based on what I've seen in the real world. So that's why today I'm going to share with you, based on my experience, why chasing the highest rate of return from these three strategies may not make you the most amount of money and what to focus on instead. To begin with, let's say you take your $200,000 in equity, you put that into the share market. Now remember, I said that you also have a spare $2,000 each and every month. That of course will more than cover any interest costs on that $200,000. Now, with the share market, let's go for a 10-year time frame and let's assume an average rate of return of 10% per annum. That would be pretty good. Over the 10 years, your $200,000 goes to nearly $500,000. Now, again, I'm not assuming any kind of reinvestment of dividends or anything like that whatsoever. I'm simply taking the capital here just to make the argument simple. Now, of course, there are some drawbacks though with the share market and some advantages. The big advantage is it's a liquid market. That means you can buy today, and if in a week's time you realize, something's happened, you want to get out, you can sell. On the flip side, there's a lot of volatility associated with the share market. This is one reason why many people in their mid to late 40s or even 50s planning for retirement are looking at their super and going, they're not happy with the fact that the super has such exposure to the share market, mainly because they don't like the volatility. They don't like the fact that the share market could respond quite disastrously based on what mood the US president wakes up in tomorrow morning. So therefore, they're taking their money out of the share market, transforming their super fund into a self-managed super fund and putting it into property. I'll come back to that in just a moment. So essentially, a big advantage of the share market is liquidity. You have access to your cash whenever you want. One of the downsides of the share market is the massive volatility, and you need to have, the emotional strength to be able to ride that through. Now, how does that compare to the property market? Well, let's say again, you take out the same $200,000 of equity, and now you go and buy an investment property. But let's say that the property only gives you on average a 7% return every year for the next 10 years. Now, immediately the pro share people will tell you that the share market got a higher return, as I'm openly admitting in this example. So therefore, the share market must be better for your investment. But what are they missing? Well, with a $200,000 lump sum of equity, when you're buying in the share market, you're essentially buying $200,000 worth of shares. But with property, you're not buying $200,000 worth of property, are you? No, instead, you're going to use leverage. So you can take that $200,000 and let's say buy an $800,000 property. Now, of course, that property is going to be negatively cash flow to begin with, especially with where interest rates are right now and where the property market is right now. However, remember what I said earlier on, you also have a spare $2,000 each and every month, and done correctly, that spare $2,000 a month will cover any shortfall from the rent versus your costs. So it won't be affecting your lifestyle. Now, an $800,000 property, if it grows by 7% per annum after 10 years, it's worth over $1.5 million. Now, if you sell, you then need to maybe pay back the debt. Let's assume the debt was $600,000. You're left with over $900,000 by putting the same $200,000 into the property market and getting a lower return than you did on the share market purely because of leverage. Now, you might say, what about capital gains tax? Yes, you need to pay capital gains tax, but that's also the case with the share market. That's the case with any investment vehicle. So we can exclude tax from this comparison. So you can see here that when we're looking at investing in property versus investing in shares, even if property gets a lower return on average, and that's what I'm assuming in this example, but that's not necessarily always the case. But let's just be conservative because of the concept of leverage. Because you can use $200,000 and get potentially an $800,000 property, you are getting your returns based off a higher number. That's the advantage of buying property. But of course, it's not all positive, right? Property is a long-term game. It's not liquid. You can't buy a property, have it rise in value and just say, oh, can I get an extra couple of grand by selling off a particular portion of the property? Yes, of course, you could potentially refinance and take out equity, but still, it's not a liquid vehicle. So if you're looking to buy an investment property, you're looking to buy and hold for the medium to long term. On the flip side though, what you also don't have and don't have to worry about is the massive volatility. You don't have to worry about waking up and seeing that your asset value has dropped 10, 15% overnight, maybe because of something that happened while you were sleeping. That can happen in the share market. We've seen that happen just this year alone and many times in the past. So for people who have a lower risk appetite, especially when it comes to volatility, they don't want to see their investment falling away, especially they're getting closer to retirement. Property provides a much lower volatility based investment vehicle. And with the concept of leverage, assuming you have the borrowing capacity and the surplus cash flow, as I said earlier on, it can be a great way to build wealth over the long term without worrying about the ups and downs that come along with the share market. Now, of course, though, buying property does involve a lot of work. You're dealing with bigger numbers. You need to do your due diligence. There's a lot more negotiation involved. Like when you buy a particular share on the share market, you're not negotiating the price. You're just buying the price that's on the exchange. Whereas with property, there's negotiation, there's research, there's further due diligence. So there is a lot of work that needs to be done. So done correctly, it can really benefit you, but done wrongly, it could hurt you. So if you're someone who's thinking about buying an investment property, so you don't have to worry about the volatility that maybe comes with the share market, but you still don't want to make an expensive mistake, check out the link in the description below to get totally for free my due diligence checklist. This checklist is something I've developed based on my now 23 years of investment experience. It's the same checklist we go through when helping clients buy properties that are more likely to give them higher returns with lower risk. So if that's what you're looking for, click the link in the description below and get totally for free that due diligence checklist. So if property can deliver more upside in terms of return with lower volatility, the next question becomes, should you then focus on paying off debt more quickly, or should you look to invest first? Because remember, I did say that in this example, you do have a spare $2,000 per month. And what a lot of people get wrong is they think that if they have that extra money, they should pay off their mortgage more quickly and they should become debt-free faster. Now, that sort of advice might have worked 10, 20 years ago when our parents or our grandparents were looking to build wealth through property, because at that time, prices were nowhere near as expensive as they are today. Property prices didn't rise as quickly as they are right now. So you could potentially pay off your home first and then look to invest. But today, is that realistic? The average house price in Australia has just reached over $1 million. Let's take an 80% loan of that. That's $800,000. How quickly can the average person pay off a mortgage on $800,000 and pay it so quickly that they can then start investing? The odds are that paying your mortgage off more quickly will actually hurt you. Let me explain. I spoke to a couple recently who regretted their decision to pay off their mortgage more quickly. They said, Nero, we had the extra money like you talk about, and every time we thought about investing in property, we heard the voices of our parents in our head saying, no, get out of debt. All debt is bad. Pay off your debt more quickly. And they did. They did pay off their mortgage more quickly. Instead of 30 years, they paid it off in 15. But here's the problem. When they then looked around to see how much property prices had risen over that 15 years, they were stunned to see what it would cost them to buy an investment property. And they came to me with almost tears in their eyes because they felt they'd missed the boat. And yes, they had missed out on opportunities, but I was still able to find them other properties that could work for them. But there was no doubt about it. I couldn't help them make up for that lost 15 years when they could have perhaps bought at least one other property and that could have doubled in value over the last 15 years. So instead of seeing all debt as bad debt, actually strategically start using debt and leverage. What do I mean by that? I mean that when you can afford to, based on your equity and your cash flow, look to buy an investment property as soon as you possibly can. Instead of taking that $2,000 per month surplus cash flow and putting it onto your mortgage, instead use it to get another property as soon as you can and have that rise in value. I'll show you the numbers in just a moment, but just from a conceptual perspective, if you can see that property prices are rising on average over the medium to longer term, why would you then want to wait until you buy an investment property if you're in a position to buy already? Now, of course, I'm not saying buy blindly. You need to do your due diligence, but buying the right property in the right area as soon as you possibly can. Can you see how that's going to allow you to build wealth more quickly? To illustrate that, let's have a look at an example. Let's say that your interest rate is 6.25%. You have a mortgage of $1 million and you have an extra $2,000 a month to put towards that mortgage. And if you decide to do that, you'll pay off your 30-year mortgage in 18 years, saving you $536,000 in interest. Now, if you consider that as after-tax dollars, that means that it's equivalent of earning $850,000 extra. That's what you've done by just putting an extra $2,000 a month into your mortgage and paying it off in 18 years rather than 30 years, saving yourself 12 years on the mortgage. Now that might sound amazing, but what's the cost of that? Well, you've just delayed starting your property investing journey by 18 years. And what do you think is going to happen to property prices over that 18 years? Likely they're going to be a lot higher. So ask yourself, what's the cost of not buying a property sooner? Then consider this. If you've waited 18 years to buy an investment property because you wanted to pay off your mortgage more quickly, let's say you got your home at 35 to be conservative. 18 years later means you're now 53 years of age and you're going to start your investing journey at 53 and you want to retire maybe by 63 or 65. Yes, if you're already at this stage, you haven't missed the boat. You can still build more wealth than by just doing nothing. However, if you could start earlier, can you see how that's going to be beneficial? You could have just bought one investment property and have that double or triple over that time period of 18 years. Plus, over that time period, your rents would have risen. So instead of it maybe costing you $2,000 a month like you started off with, over that time period, at some point, if you bought correctly, that property would have likely become neutral or started costing you nothing and maybe even started giving you positive cash flow. So your investment property could then start helping you pay off your mortgage more quickly. So yes, paying off your mortgage quickly, that's a great goal, but don't do it by sacrificing your ability to create wealth. If you had the equity and you had the surplus cash flow, not investing as soon as you possibly can in the right areas, it's going to cost you a lot of regret when you look back and just wish you'd bought property 10, 15 years earlier. In fact, let's have a look at the numbers. Instead of putting that $2,000 extra into your mortgage, let's say you take that $2,000 per month surplus cash flow plus the equity of $200,000 that you had and you put it into an investment property. Say it's $800,000 when you buy it. Now, when we're talking about a property costing you $2,000 per month, that's before tax. Then you have negative gearing benefits and potentially some depreciation benefits, even if you're buying an established property. So when you do the numbers, you might find that instead of costing you $2,000 per month, the property might after tax only cost you the equivalent of $1,200 per month. That still gives you an extra $800 per month. And what are you going to do with that money? You'll put that towards your mortgage. And that means that you still end up paying off your home mortgage 7 years later. You still save over $300,000 in interest in after-tax dollars. So that's going to be the equivalent of earning an extra $550,000 in actual earned income. Plus, you also have an investment property that's growing in value and giving you rental income so you can get the best of both worlds. That's why I say you don't need to choose between paying off debt first and building wealth. Those two strategies are not mutually exclusive, no matter what our parents might have taught us. The fact is that done correctly, you can have both, but you do need to exercise a level of care here. You do need to follow the right strategy. It's not always easy to do the numbers and do the research and then do the negotiation and find the properties on your own. So if you want some help with that, check out the link below to book totally free a no obligation consult with my team, where we can find out more about your goals and then share with you how we might be able to help you achieve what I'm talking about here. So if you're leaning towards buying an investment property, but you're not sure what to do with your money, and let's say maybe instead of $200,000, you have maybe $100,000 or a little over that, check out this next video where I talk about what I would do if I had $100,000 in available cash or available equity and how I would invest. I talk about the criteria you need to look at, the data factors you need to consider, and the right strategy to follow so that this next investment property you buy can be a stepping stone to buying future properties and paying off your debt faster. So check out that video now.